Hello and welcome to our third interview in the William Buck investment series, Private Equity. I'm Adrian Frinsdorf, Director at William Buck. Today I'm here with Ellerston Capital Investment Director, David Leslie. Welcome, David.
Thanks, Adrian.
We want to get a little bit more of an understanding of private assets. Probably to start with, how did you get started in investing in private asset investing, and what excites you most about your job?
So I started in private asset investing coming from a background of public equity. So I've been with Ellerston for 16 years. So I joined in 2005. And my day job originally was working on our public equity funds, looking at a lot of technology businesses, but really public equities. In 2010, we started seeing some of these private companies coming onto our radar, and we originally began doing them as club deals. So a few of our colleagues in here at Ellerston would get involved. And I guess what I saw as being really exciting about it was, one, we were getting involved in earlier stage companies, but more exciting was we're able to actually have an influence, to sit on the board, to be involved with the founders, to sit alongside them and leverage our experience and sort of know-how in trying to help these businesses scale up, raise capital, and in many cases go towards that IPO outcome that many of them were sort of seeking for their businesses. So I guess what I really relish about private assets is the fact that you can actually be hands-on, an active management process, whereas when you're dealing with public equities, sometimes it feels like, you're being told the same stories, through the veil of corporate governance. There's little, information that you can have. And so you're sort of dealing with the inefficiency of knowing what everyone else knows. But in a private company, you can access any piece of information you want about a business. And if you want to focus on the pricing strategy, the North American market entry strategy, you can really lean in and get involved and try and help a business. It's a really fun way to work with great people in some of these up and coming companies.
I guess one of the key to that is identifying them. I'd imagine with the ASX 300, there's a defined market in public equities that you can look at where to shop, so to speak. How do you go about finding opportunities, and is it difficult?
We rely a lot on our private networks. So, I've been investing for a long time. And so there's a large network of companies that we've dealt with, investors who've supported us, and just advisors out there. We don't generally end up investing in companies that have been walked around by brokers, but really they come out of private referrals. So someone might refer a business to us that where they know the founder or there's a personal relationship, and those warm introductions are really where it begins. In Adelaide, we've got one of our portfolio companies, CAMS, and that came through one of our lawyers who had a relationship with the company. And so again, those personal networks and referrals are really important, but we meet hundreds of private companies a year, and this is a really low volume business. So we're meeting a lot of those companies just to get that data around the private industry so that we have real deep advantages and knowledge once we do get involved. But it's a heavy intensity process getting to know a private company because they don't always have their information at their fingertips. So an investment decision takes us 3 to 6 months. So we meet a lot of companies, but once we find something we like, it's really a deep dive in getting to know them and being convinced we want to work with the company and have a relationship with them as much as they want to have one with us.
So what are those factors that make you like a company, or what is a good investment that you will look at and screen and do that due diligence in?
So you can't say it often enough, but it's always about the people. We're like an invited guest when we get involved with a private company, where we've got to be able to sit down with the founders and their management team, because you're a long time in a private company. You can't just sell and move on like a listed equity if you disagree with where they're going. So having that relationship and the confidence that you can work with them is clearly going to be the number one thing. But from a business characteristics point of view, we're looking for businesses that have high growth. So, high growth potential and can demonstrate high growth capabilities. We're looking for businesses that might not be profitable, but have great unit economics. So we can see that as we allocate capital, that they'll turn eventually into profitability and cash flow and sustainable growth. We're looking for large markets. So we're not prescriptive about businesses having to be global. In fact, some of our best businesses are Australian only, but they've got to have large segments of the Australian market that they can address. But what we're really looking for is businesses that we think can grow for a very long time. So if we're going to be investors for 3 or 4 years as a private company, if we then go to sell it or list it, at that point in time, the new investors or the new owners of the business will see that there's still another 5, 10, 20 years to go for a business's growth journey. So we're not looking for a business that might be, you know, a fast growing business, but it can only do it for 2 or 3 years. It's got to have a long duration growth profile. So that really lends itself to a lot of the technology businesses that we're attracted to.
One of the investments I'm aware you have is a group called Mable. That's certainly a fast growing business. Do you want to tell us a little bit about that as an example?
So Mabel's it's a wonderful business for many reasons, but what part of what attracts us is it's a business for profit, but for purpose. So it's got a very good sort of ESG lens to what it does. What they do is they're a marketplace providing services to people with a disability, so the NDIS program, or aged care, so the aged home care packages. On one side of the marketplace, you've got the families or the individuals that have access to maybe some government funding, but are looking for support. And through government funding, they're now able to make their own choices about the carers and the people that they want to look after them. Mabel's a marketplace, so it's almost like a dating site. And on the other side, we've got carers and people providing services to these individuals. And so through the algorithms, again, like a dating site, you match up. So if you've got a child with autistic needs and they're looking for someone to help them, you know, to learn music and look after them in the afternoon, maybe your family speaks a language and you're looking for that attribute, you go to Mable and you search through the workers to find someone that meets your individual requirements. The platform then sets the rates. Sorry, the work between the worker and the family, they agree the rates, but the platform then manages the billing process, the invoicing. There's a lot of screening that the platform does, maybe working with children checks, police checks, those types of things. So it creates this marketplace, and which then leads to a sort of a really interesting network effect. Because once you've got one worker supporting you or your family, then you tend to have that worker for a long period of time. You tend to bring other workers in, and then through your own sort of associates, often there's a word of mouth effect about, I've got these great carers helping me from Mabel. And so this business has really gathered a lot of momentum. It's gone from being a startup 6 years ago, and with just $25 million of capital, they're now doing $170 million in turnover of delivered care. So it's the largest home care provider in Australia, and it's still been growing at growth rates around about 100% year over year. So even though they've achieved scale, there's still an incredibly long runway. They're about 1% of their addressable market, because the government, certainly in Australia, is providing more and more support for individuals so they can stay in the home longer and have greater access to their individual home care needs.
Yeah, it's a great business. That sort of business on the share market would probably trade on healthcare businesses, if we classified that, at probably 25, 30 times earnings. What does valuations look like in the private markets compared to public markets?
We look at private market valuations and apply a sort of a discount. We'd expect there to be a 30 to 50% discount on average when we invest. So we sort of see there's two arbitrages that we're effectively trying to capture. One, there's that valuation discount, 30 to 50% cheaper than a comparable listed company. But two, because our private companies are able to sort of be very focused in what they do, and maybe they're a bit younger than some of the listed comparable businesses, we also find that they're growing significantly faster. So if you look at the ASX, where there's 4% of the market in technology companies, that 4% of the market is the fastest growing segment of the ASX, and their average revenue growth for the next 2 years is forecasted about 15 to 20%. Currently, our 5 portfolio companies are expected to grow at more than 40% for the next 2 or 3 years. So the two value levers we're trying to capture is the discount to the listed comparable businesses, but also the fact that they're growing much faster. And so they're the two levers that we hope help us to deliver the sort of 20% returns that we're hoping for the fund.
Fantastic. Thank you very much for your time today, David, providing a bit of insight into private markets. We think they have a very valuable role to play in portfolios because the world is getting harder to find good investments. So thank you very much.
Thanks, Adrian. Enjoyed the chat.